value stocks, with particular emphasis on the price to earnings ratio. As I mentioned in the last video, how can you judge if a stock is on sale by looking at its dividend? Well, let's consider the dividend per share is fixed, as it's decided at the annual general meeting or whatever meeting that the company decides to agree on their dividend. So that does not change on a day-to-day basis, but the share price does. So therefore, as the share price comes down, the dividend yield goes up. However, what if a company doesn't issue dividends? What then? Well, what does every single company in the world need if they are to stay in business? Profits, and profits alone. So let's take some sorts of profits that I have picked up over the last while. Well, Nintendo made 114 million in profit from the Wii alone in 2008. In 2008, Tesco made 3 billion profit. In the last 3 months of 2009, McDonald's made a profit of $1.22 billion. In the last 3 months of 2009, Disney made a profit of $844 million. And in the last 3 months of 2009, Coca-Cola made profits attributable to shareholders for $1.54 billion. So what do companies do with these profits? Well, in some cases, and in many cases, they put some back into the company, they pay off debt, but the other thing they do is they pay out dividends, as I mentioned, as an incentive for you to buy their stocks. So what else are profits good for? Well, they are a major indicator of how well a company is performing. If profits are high, the company is doing well. If profits are low, the company isn't doing well. So as a result, profits or earnings are the main driver of share prices, so investors are very interested in them. And I'll just interrupt here by just mentioning the point. There are only 2 reasons a stock will rise. One is if its earnings rise, and second, if its price to earnings ratio rise, as its price to earnings ratio is a measure of the sentiment of the market. So what are earnings? Well, I have an extremely simplistic profit and loss statement here. It's simply revenue less costs is your profit. So as an investor in the company, you are hoping that as the earnings of the company rise, so too will the price of the share. So wouldn't it be a good idea to buy those earnings as cheaply as possible, i.e. buy them when they're on sale? So introducing the price to earnings ratio. How can I judge if the stock is on sale by looking at its earnings? Well, the lower the share price, the lower the price to earnings ratio. While the earnings of a company does change on a daily basis, the earnings per share is only announced periodically, so we'll consider that to be fixed. So the lower the price, the lower the PE ratio. So the earnings per share are calculated at regular intervals and published, so for the sake of argument, the EPS, i.e. earnings per share, is fixed until the next announcement. Earnings do not change on a daily basis, but the share price does. So when the EPS is fixed, as the share price decreases, so too does the PE ratio. The lower the PE ratio, the cheaper the earnings, and that's the way to find more valuable stocks. So let's take Chelsea FC, produced earnings per share of 54 pence. The share price is 10.54, so the PE ratio is simply 21.37. This means that the share price is 21 times on average earnings. So a low PE strategy would be to pick 10 stocks which offer the lowest price to earnings ratios, hold them for a year, and sell them the next year if they are not still offering the lowest PE ratio. We choose a year so as to give the companies time to develop. Too much chopping and changing and incurs many transaction costs and doesn't allow the stocks to grow. So the features of a successful strategy, well, one is know what to buy, and you do know what to buy. They're simply the stocks with the lowest PE ratio. Secondly, know why you're buying it. They are offering the earnings at the lowest prices. Know when you will sell. Well, again, you'll sell in a year if they're not offering the lowest PE ratio. Buy a number of stocks. I would suggest to buy 10 to diversify, and this strategy has been tested by many financial analysts. So now, to do it in real life, what do you need to do? Well, each company has a website where you can find the investor information, usually under investor relations. Look for the basic EPS, earnings per share, and compare it to the price to find the PE ratio. So if you were to take a company like Nokia, to go to Nokia's homepage and then go to the button here as the arrow points to investors. And then when you go into investors, you can look at earnings and presentations. So you can see down here what the earnings per share is, and you can also see what the dividend per share is also. And now if you look at the whole picture, here will give you a good idea of what's going on in the company. What is the company name? What does the company do? What is the dividend yield? What is the PE ratio? Is there anything else you feel important? But most importantly, would you buy or not buy? And for any teachers looking at this video, this is very similar to a Leaving Cert accounting question, so I do bear that in mind as well. This is Susan Hayes, the Positive Economist.